Hello, one and all present here. I am Subhajit Hazra, and today I'm going to talk about financial literacy 101, building a secure future. I'm basically going to talk about how you would manage your income so as to have a better future for yourself, right? We have hundreds of mechanisms that we can do this through, but then I'll take you through the various mechanisms that we have, the basics of the various mechanisms that we have. Obviously, we can have more, we can discuss more about these mechanisms, but it's first very essential to know about the basics of these mechanisms, right? So I'm Subhajit Hazra, Operations Director of Life to and Beyond Foundation, and also an Assistant Professor at ICFI School of Pharmaceutical Sciences here in ICFI, Dehradun. So I'll be basically taking you all through these contents, table of contents, which we will start one by one, starting with financial literacy and ending with the various regulatory frameworks that we have and the common mistakes that we as investors tend to make, right? Right. So first question that we should ask ourselves is financial literacy is okay, but why should we even need financial literacy when when we already have so much degrees with us, right? So financial literacy is the ability to understand and effectively use the to use the money that you have earned, so that it's not only there when you need it, but also grows as you grow, right? So this is what financial literacy teaches you. It's not only earning money, but then growing the money that you have earned, right? Uh, and for this, you need to make smarter decisions. With these smarter decisions, you can achieve your life goals, right? Manage debt in case of situations where you have taken some loan from the bank, and also secure your as well as your family's future, right? And obviously, doing all those, you can grow yourself and your money and reduce the financial stress that we all have in that we all face day in and day out. Also, because of the fact that the prices of things are going increasing day by day, right? So it's this pressure that we can reduce, the rising pressure of the inflation that we can reduce if we are financially literate, right? Right. So first of all, we need to understand the basics of the financial market that we have, the landscape as we call it, right? So India has two financial exchanges, stock exchanges. One that was developed way before our independence, right? It was known as the Bombay Stock Exchange, and recently, which has been established, which is the National Stock Exchange, right? So you can see various features of National Stock Exchange listed and various features of Bombay Stock Exchange listed, right? But having understood this, having seen this, we have to understand that what it's not just these exchanges, but the parameters on which these exchanges run on, right? The flagship index of National Stock Exchange being Nifty 50, and the flagship index of Bombay Stock Exchange being Sensex, right? So when we before National Stock Exchange, when we had Bombay Stock Exchange, what we used to do, we used to invest in Bombay Stock Exchange, and the way Sensex used to uh, move forward as well as backward is how we as Indians used to evaluate the monetary value of India, as well as monetary power of India, as well as the money that was invested in Bombay Stock Exchange. And going forward after independence, we understood that Bombay Stock Exchange itself is not um, it's not fulfilling our need, but then we need to have something more advanced based on recent monetary parameters that's going on in this world, and therefore we had to establish a newer stock exchange known as the National Stock Exchange, right? So, but what are the key differences that we need to understand when understanding Bombay Stock Exchange as well as National Stock Exchange? Here in the left bottom corner, you would see that various features of Bombay Stock Exchange as well as National Stock Exchange has been listed. One of the very key features which I personally ask young investors or very new investors to look upon is that Bombay Stock Exchange, though is a old one, it has a very moderate growth as well as a very moderate downfall when it comes to a crash down of an economy, right? And this is the exact same scenario. This is the exact same scenario, but an opposite scenario, which takes place in the case of national stock exchange. So when the economy is going high, you would see national stock exchange going up very rapidly. But then when the economy is going down, you would also see national stock exchange crashing down very rapidly, right? So when you're as a young investor, when you're starting to invest, you should have a very clear view on where you should invest, right? Should you invest in Bombay Stock Exchange? Should you invest in National Stock Exchange? Or should you have a mixture of both so that you can absorb that shock of fall, as well as have that value of gain when our economy is rising, right? So this is all about the two stock exchanges that we have, one National Stock Exchange and the other Bombay Stock Exchange. Going forward, in these exchanges, there are multiple instruments that we can invest on, right? One of the instruments that's widely known is the equity market, and the other being the government securities, right? See, equity market, if in one line I would have to define equity market, it's like buying a portion. It's like having your investment, having your money invested into a company. As a commoner, we can't buy the entire company, but then we can be a proud owner of one of various companies when we invest our small amount into our company, right? And that is what is known as equity shares, right? Having understood equity share, now we have to understand what government securities are, right? So government securities are when government is taking some money, is raising funds for national building, right? For, let's say, government is raising fund to build a bridge. Let's say government is raising fund to build our national highways. So government issues some national securities, or commonly known as the GSECs, where you can invest and be a part of nation building, whereby it's not your money which is getting invested in nation building, but also when that money government is using your money, it's also giving you a fixed interest on your money, right? And let me tell you why. One of the very few questions that come up to me, that should come up to your mind as well, is why we should invest in equity market or as well as government market when we already have very stable investment options like fixed deposits, like recurring deposits, right? But if you all compare the interest rate, you would see that the kind of interest that we get per unit of time that we get uh, in the very traditional instruments like the fixed deposits or the recurring deposits, these are comparatively less than the kind of interest that we get in equity shares, the kind of interest we get in government securities, right? So this is one of the key factors why the current youth or the current population of our country, or let's say the population of the world, is shifting from the traditional bank based investment, namely the fixed deposit or the recurring deposit, to a more open market, which is also known as the equity share or the government securities, right? One of the key features, which I would discuss in my following slides as well, but one of the key differences between equity shares and government securities is the same as we have discussed with BSE, Bombay Stock Exchange, as well as National Stock Exchange, being that government securities give you a very low return as compared to equity shares, but then government securities are comparatively stable when it comes to downfall of an economy, right? So you have to maintain a balance between the both rather than just giving one all of the shot with trusting one with all of the money that you have. So to maintain that balance so that you have that shock bed when there is a downfall in the market, right? So these are the major two considerations till now that you have to remember. One, which market you have to invest in, and if you are investing in either of the market, let's say Bombay Stock Exchange or National Stock Exchange, but which instrument to invest on? Is it like equity shares or is it like government securities? Next, the
Hajra,
next is
1 second. 1 second. Can you please use your cursor to like specify on the slide, given there are a lot of things on the slide, and it will be helpful.
right.
Hmm.
So coming first discussing, as I mentioned, that we have equity shares as well as government securities. First, we would discuss on the equity shares and then on the government securities. So first, coming up to the equity share, as I already mentioned, that equity share is uh, like taking an ownership of the company, right? You can't buy the entire company, but you can always be a proud owner of the company when you buy some share of that company, right? So this is all about equity funding or equity investments, right? It's very interesting to note that individuals like us can invest in big companies like Reliance, Apple, Tesla, right? And there are multiple ways to do that, right? There are individual stocks that you can invest in, there are mutual funds that you can use, also something known as exchange traded fund, and something which is also known as private equity, right? But now that we have already entered into knowing what equity investments are, we'll slowly and steadily dive deeper into these four components, right? So the coming into the like stating the first component, individual stocks. So companies, when they are listed on either of these two exchanges, let's say Bombay Stock Exchange or National Stock Exchange, they once they are listed, they start giving out their stocks, right? They start giving out their shares, and each share consists of certain amount, right? Let's say each share would cost you, let's say 50 rupees, right? So you can it's up to you to choose how many stocks or how many shares you want to buy, right? If you have a money, let's say if each stock is of 5 rupees, you have 100 rupees. So how many stocks you can buy with that 100 rupees? That is what you have that saying that this much money I have and this much stock I am going to buy. But things take a very different turn when you go on to invest in the mutual fund. The next instrument under equity investment that we have is a mutual fund. So what is mutual fund basically? Mutual fund is basically a basket, right? Whereby you don't have that liberty to choose that, okay, I will take five shares of this company. I'll take 5 shares of this company. Okay, I don't have money, so I'll take only 1 share of this company. And let's say 5 shares of the stock which is of a lesser price, right? So you don't have that liberty to pick up individual hand-picked stocks, but then you have to go with the basket that's already been provided to you. So you have various baskets. You have to choose which basket should I invest, and there are ample number of parameters to choose which basket you can choose, but then that's a different story altogether. That would take a different session altogether for me to let you all understand which basket to choose. But as a matter of fact, just we have to remember now that individual stocks differ from equity stocks in the aspect that when buying individual stock, you can actually have a say that how many stocks you want to buy based on the number of amount of money you have. But then when you are investing into mutual funds, you don't have this say, but then you have to choose between baskets that already has been pre provided to you, right? Let's say a basket which consists of four stocks of electronics sector and one stock of, let's say, energy sector, right? Again, you have some basket which has more stocks of energy sector, less stock of oil sector, right? So you have to understand which stock is in trend. When I say trend, it's not the trend as we understand in fashion, but then trend as far as the world, as far as the world geopolitics is running, right? If I dig a bit deeper into this, it's now that we know that there is a huge conflict going on both in Russia and in Ukraine, as well as a conflict going on in the Strait of Hormuz, right? So how would stocks get affected into this, right? So because of this war that's going on, right? It is a very it is understandable that a war needs machines, or um, a war needs various warheads, right? So various companies which are investing into these warheads would have a greater say, would thrive more into such a situation, while companies which are investing into oils, let's say companies which are making cars, which are making various trucks, would have a low time now, because people, having understood that there is an increase in oil prices, would invest less into buying cars, right? So I would go at this point in time, if I have to purchase a mutual fund, I would go with such a basket, such a mutual fund basket, which has more oil stocks into it, right? Let's keep that, and then keep that stock basket with me till I have that this leverage of let's say this leverage of um, this leverage of geopolitical situation with me. Let's say if I know that there is war going on, right? I would have more. I would have a basket which has more of those companies which are producing ammunitions, right? And then keep that basket with me until that war is going on, and then sell off those when I understand that now war has ended, and this stocks are again going to go down. So this is how the geopolitical situation has an effect on all the stocks as well as effects on the mutual funds. And when you are particularly buying the mutual funds or the baskets, as I'm talking, you have to be very aware of the geopolitical situations, right? Because here you can't handpick stocks, you have to go with the already available basket that you have, which is not the case in case of individual stocks when you are buying, right? This is to do with individual stocks, and then to do with equity mutual funds. Now comes exchange traded funds. As this series goes, right? Individual stocks, then comes mutual fund, then comes equity exchange traded funds. This is also the order in which there is a reduced chances of risk, right? There is a high risk when an individual or an investor tries to purchase individual stocks, high risk. But when he or she again thinks of buying an mutual fund, investing in a mutual fund, there is a comparatively lesser risk, because you have a basket of instruments to invest on, which would kind of absorb the shock, right? Absorb the shock from one stock, and whereas where few stocks are declining, as well as few stocks are increasing, right? But then a more stable option or a more moderate option to go with for newer investors is exchange traded fund, which simply kind of stimulates the kind of tracks the basic tracks the what to say, the parameter that we have for Bombay Stock Exchange, or the basic parameter that we have for National Stock Exchange, right? Like the Nifty 50, like the BSC, Bombay Stock Exchange parameter that we have. So it's a more stable option. Definitely, since it's a more stable option, the kind of returns that you get in exchange traded funds is a bit less than the kind of return that you get in individual stocks or mutual funds. And then finally, coming to private equity. Private equity is something very similar to individual stocks that you are buying, right?
Hajra,
Uh,
we may have to wrap up in the next 5 minutes.
right. Okay. So having understood this equity investment thing, now we have to understand what, yes, how to choose between one. I have already discussed on how to choose between one, because you see, individual stocks are at very high risk. Comparatively, as I go from left to right, the risk decreases, as well as also the kind of money return that you get also decreases. So if there is a high risk, there is a lesser return. If there is a lesser return, yes, there is. If there is a high risk, there is also, sorry, if there is a high risk, there is a higher return. If there is a lesser risk, there is also a lesser return. This is the basis on which the investment stands as far as the equity investment option stands, right? Now coming to the government securities, as I have already told, that government in the for nation building opens up with certain options where you can invest in terms of treasury bills, in terms of government bonds, in terms of even sovereign gold bonds, right? State development loans that the government opens up, whereby you can invest in state development loans, whereby the state government is taking loan for building a bridge, let's say, for building a road, let's say. And then once you are investing, helping out the government to do so, they are also returning, not just returning you the base amount, but also returning you the base amount with some interest, right? But always remember that these interests are comparatively low than those which we have for equity funding, equity shares, right? So these are the various options that we have. One thing that I would like to mention over here is when you are choosing between government bonds, central government bond and state government bond, be very cautious on this, because central government is something which is is a bit more stable right? It's a bit more stable. It's seen that central governments are a bit more stable than the state governments, right? So investing in both in you have to choose wisely when investing in a state government bonds or investing in a central government bond. It's seen that central government bonds are a more lesser risk free than, but state government bonds can be a bit more riskier, right? So you have to this is a general perception that I have found while investing the days I have been involved in investing. But then a more as far as government securities are concerned, a more stable option and a more tension free option would always be treasury bills, not because it's giving you a handsome interest, but also the amount of tenure that you have to stay invested is also very less, right? Because risk also increases when you have to stay invested for a longer time than the time if this tenure when you have to stay invested decreases, right? And then finally coming to the various like
Hazra,
balancing the risk.
one more minute. If you
Yes.
could
So
quickly wrap up.
yes. So now coming to balancing the risk and returns. So it's there is only one line that I would like to add over here is you don't just remember that it's not just one instrument that you can go with while investing, but you have to explore various options like government securities, like equity investment, the various instruments that we have inside equity investments, the various instruments that we have inside government securities, and have a mixture of all of these instruments while when you are investing your money. Don't go with just one type of investment, one kind of instrument for investment, but have a mixture of all the investment, all the instruments while investing, right? And last but not the least is what I say is don't just run after returns. Like it has been seen that people always run after historical returns. It's seen that okay, last year they have given 50% return, this year also they would give 50% return. No, don't go always for better return, chasing after better returns, but then always consider the geopolitical situation when nationally as well as internationally when you are investing your money. So this is the key line which I would like to end my presentation with. Thank you.